The reality is for most people is that they could be investing and making money in the stock market every single year, and the vast majority of people sabotage themselves before they ever make any money, or if they do, they end up losing it because they basically get in their own heads and sabotage themselves. So in this video, we're going to talk about why this is and how to avoid it, and how most people make money in the stock market, and basically how pretty much everyone has done for the past 30 years, depending on how long you hold. So I've got a nice little list here of things that we can talk about. This is my rundown of the psychology of investing. And the first one is, like I said, investing is actually very, very simple. It's the part that makes it so difficult is our human behavior. We're obviously always subject to our emotions, and the reality is being subjected to your emotions means that when markets go up and down and there's money involved, it's very easy to get overly emotional, to buy at the wrong times, to sell at the wrong times, and we often get in our own way, really, especially in regards to money. We know as humans it is very, very difficult in general to save money, and the reality is the vast majority of people, as soon as they get money, they spend it and then they don't invest it. And this is something that can be difficult for people. Even if they do eventually get themselves to start investing, they may find themselves not investing consistently, or they may find themselves, even worse, selling when the market goes down and then buying when the market goes back up, and missing all of the good moves in the market that make people profitable in the long term. So the reality is, number one, investing is simple, but that doesn't mean that it's easy. Especially as humans, like I said, emotions play a absolute havoc on the majority of people who are trying to invest. Take it from someone who knows I am a full-time Forex and also index trader. I day trade in those markets, and believe me, mastering your own psychology and emotions is absolutely critical in markets in general. Even as doing something as simple as, putting £100 a month into the World Fund ETF and basically going, yeah, this will be good, this will do it. But the reality is, it's not that easy, and it's not as easy as you might think when money's on the line. Money is important ultimately. Everyone wants to have more money. No one wants to lose money. So when you see sometimes you're losing money in the markets day to day, it can be difficult. But these are things that you have to get over if you're going to be a long-term investor. The psychology of investing demands that you detach yourself from these emotional scenarios that you may find yourself in. You can see here, what if doing less actually makes you more money? In the vast majority of cases, I would say at least 95% of people, simply buying the Global World Fund and then buying it every month and holding it for 30 years will make you more money than basically anyone else would any other way for the vast majority of people. This is just the reality, and really the sooner that you start, the better. Obviously, as always, this is not financial advice, but this is my advice in terms of for my own personal experience. This is my own experience of what has happened to me. I've been investing in the stock market for the past 10 years. I've been investing every single month, and it's made me way more money than any other business venture that I've ever done. And that's just from being consistent, buying into the stock market every single month, whether it's up or down. And basically, that's how I've made, and many, many other people have made, tons and tons of money. Just consistency over a long period of time in an asset that consistently goes up. If you bet on the global world economy doing better in 50 years than it is now, then buying every single month doesn't seem like such a crazy idea to me. So number two, why we make investing complicated. We're always looking to find, the next Tesla or the next Nvidia that goes up 10x in 2 years, and, you make basically an incredible amount of money. You put $10,000 into Tesla 7 years ago, and it's worth probably $500,000 now, maybe something like that at the time of recording. The reality is there's always going to be outliers, but it's basically impossible to find them, and you'll have to be extremely lucky to be the person that buys them. And take it again as someone who knows from experience, entering the crypto market myself 6 years ago and investing a lot of money in a lot of coins that are now completely worthless and sitting in one of my crypto wallets as basically ethereal dust that has no value. This happens all the time. People want to chase the next shiny thing. It is, again, emotional psychology. You always feel like someone's doing better than you. You've got FOMO. You want to get more gains. You want to get more returns. There's people that are saying they can get 30 and 40% returns every year consistently. If there were people that could do that, they would be billionaires and trillionaires all over the place. The reality is this doesn't happen. Even big, massive hedge funds, etc., barely beat the stock market most of the time. These huge investors that everyone talks about being absolutely incredible investors, most of them don't beat the stock market consistently. 8 to 10% a year is an incredible return that you can leverage, but you have to be consistent and you have to do the work psychologically, which means instead of going and trying to beat the market, watching the news, checking your portfolio every day, we feel like we should always be doing something. But investing is not about being glamorous and it's not about being busy. It's about doing something consistently that you know in the long term is very likely to give you a long-term edge in the market and ultimately create some wealth for you. There's many, many examples on YouTube. Go and type it in. Here's my 10-year, 20-year portfolio. Someone just putting 100, 200 pounds into the global index fund for what we're looking at like the net last 10 or 20 years. And they're looking at like 100, 200, 300,000 pound returns in 10 or 20 years just from being consistent. And it's not glamorous and it's boring. And as humans, again, there's also managing our behavior in this regard. It's not necessarily always about FOMO, getting in and out of the market and feeling fear, but there's also feeling the fear of missing out and trying to chase gains when ultimately the boredom and the anti-human feeling of just putting £100 into something for 10 years every month and making yourself 100 grand, 200 grand or more, depending on how well things go in the market in that particular period of time. The reality is it's very, very likely that you're going to do pretty well for yourself. And it's very difficult to do. Many people can't do it. Many people can't even save £1,000 to have an emergency fund for themselves, let alone being able to do something like this where they basically go, you know what, I'm going to put £500 a month into an ETF for 10 years, make myself £500,000 in gains in the next 20 years, and then retire and live off the dividends or whatever. It's incredibly difficult for people to do this. And the proof is in the pudding. Many people can't do this. Even £100 a month can feel very, very difficult. So this is the main part of the video. Our emotions get in the way. The market goes up, we feel FOMO, we buy. The market goes down, we feel panic, so we start selling. When in reality, all you're doing is hamstringing your progress in terms of the long term. If you're going to go and buy, for example, the global index fund ETF, which on average returns 8 to 10% a year. It's been doing a little bit better recently. Some years it doesn't move at all. But in the long term, accumulating wealth, and also it's reinvesting the returns of the dividends that is provided from it. You can imagine over time this really starts to compound. But if you're constantly buying when it goes up and selling when it goes down, you're missing out on all of those really, really good returns that you get on the rebound of those drops. And if you've sold, you're not actually getting any of those returns, which tend to be some of the best in the market when we bounce back from a big crash. As you can see, we buy when things are exciting, we sell when things are scary. The situation with this is obvious. It's human psychology and emotions again. You see your money going down, you put, let's say, £100 into something, it goes down to £80, you feel like you're losing money, you're scared, so you sell, and then the market rebounds and goes up 5% in the next few months. You could have had £120, but instead you sold for what you were looking at, your £80 there, and you miss out on the £40 you could have made in the middle there because you were too scared to be in the market. It's something that you have to accept. There are going to be crashes, corrections, dips in the market, but that's usually when you should be buying and not selling. Again, from my own personal experience as a crypto investor, I had the absolute worst experience of this when I first started, where Bitcoin would pump $10,000 and go up 100% in a week, and I'd start buying and then it would go back down to $10,000 from $20,000. I'd lose half my money and I'd panic and I'd sell, and then it'd immediately go back up again. Crypto, obviously a very, very extreme example, but this is the reality of investing. And if you want to invest in the long term and be successful, and by the way, anyone can do this, people do this repeatedly, year over year over year, for the past 50, 60, 70 years, and have had extremely good success with it. Obviously, we can't guarantee the future, but the reality is the world economy is probably going to continue to grow. The situation really is that you're very, very likely to make money over longer periods of time, but it's very hard psychologically to get yourself to do this, obviously. So As you can see here, this can lead to that psychology of missing out on those big moments in the market because you're scared. And this is another important factor. We think we're better than we are. You make one great investment, like maybe you bought Tesla and it went up 5x, and you think, I could do that every time repeatedly. You think you're a genius, but it was very likely complete luck. There's no way that people can do this consistently. Like I said, every single person in the market would be a billionaire or a trillionaire if they could replicate 5x returns every year. Obviously, your portfolio would compound like crazy. The main thing to think about here is there's always going to be someone that's doing better than you, but that doesn't matter. What matters is what you can achieve consistently year over year, and pretty much anyone can do this with the right psychology. Anyone can do this. There's always going to be somebody out there that buys Dogecoin and it does 1000x and they make $5 million and they retire. There's always going to be someone that does that, but it isn't going to be you. The reality is, and this is the reality, you can make 10% a year in the stock market for the next 30 years, and by the time you're getting towards 50, 60, if you start in your 20s and 30s, you'll have £500,000, maybe £1 million, depending on how long you held and how much you put in every week, and you can retire comfortably as a millionaire. Pretty much anyone can do this, but that doesn't mean that it's easy, and it doesn't mean that everyone does do it, because it's very difficult to be consistent for such a long period of time as a human and ignore the emotions that you will inevitably feel along the way. It will be difficult. As you can see, there will be people that think they are amazing, and then all of a sudden they'll buy something, say they get their 5x on Tesla, they make 10 grand off their £2,000 investment, and then they buy something else and it goes down 80% over the next 3 years and they lose all their money and they're back to where they started. It happens to everybody, basically. And the best way that I've seen that you can mitigate this from my experience is buying ETFs for the long term, continuing to average in, and basically the vast majority of your portfolio being them. It's very, very good. And ultimately, I think in the long term, for me personally, like I said, not financial advice, this is going to pay me literal dividends in the long term, because the returns obviously can't be predicted, but on average, it's 8 to 10% over the past 40 years. Definitely something that I would take. The reality is it will be bumpy along the way, but this is the best bet, in my opinion, that people have got for making consistent long-term wealth with a relatively low risk of failure, being the global stock market. You would imagine it will continue to grow over time. You're basically betting on whether or not the world will be in a better place in 15 years from now than now, and I think that's pretty likely the case. So, as we could see here, when you're so emotional in the markets, you're buying an ETF every month, it feels boring. Picking individual stocks feels exciting because you feel like you've got a hand in the process. But the goal is not to look clever, it's to build wealth. And this is the best, most consistent way that we have for long-term wealth, investing in the stock market consistently monthly and holding and waiting and reinvesting the dividends. As you can see here, the simple approach that I've been alluding to here is pick a diversified ETF. I like the global one. That's the one that I personally buy every single month. It is weighted into the US of around 40 or 50% anyway, because obviously we know the US is a massive part of the global stock market. But the reality is, for me, that having investment in other sectors of the world is important as well, and it does lower your risk somewhat than just buying the S&P 500, for example. I don't think that buying the S&P 500 is bad at all. I think that it'll probably do very well in the long term. But in reality, I think I just wanted to be diversified across the world. So the Global World ETF for me, the ticker symbol is, I believe, let's look here. The Global World ETF. Global World ETF, reinvesting, ticker. This is the one that I buy, VWRP. Because there are obviously dividends involved, since we are buying the whole of the world's index weighted in certain ways. There are dividends, but it means it reinvests those dividends that you get, so it compounds your gains even more. This is the simple approach. Pick a diversified ETF, invest regularly, and keep your costs low. I think the fees for buying these are like 0.07% a year, extremely low fees. Investing regularly every single month has worked very well for me. Like I said, I've been investing £200 a month, every month, for the past 10 years into the global ETF, and it's done very well for me. Don't constantly change your strategy. You've got to give it time to work. The reality is the first 10 years, that's right, 10 years, will probably be pretty boring and you won't make much gains. But the compounding comes later when you've gave it 10, 15, 20 years to accumulate. You're accumulating more shares every single week, every single month, every single year. And all of a sudden, your dividends are reinvesting and your whole portfolio is growing in terms of shares. The prices are going up consistently over the years. And in the end, you're going to start building yourself some real wealth. But this is anti-human psychology. It's something that you have to overcome. You can see here the power of consistency. You don't need to predict the market. You don't need to know what's happening every month. You just need to keep investing. Even £100 every single month for 10, 20 years is going to yield you £100,000, £200,000 in terms of a wealth portfolio. And when you think about it, £100 a month, I know that we have got a cost of living crisis at the minute in the UK and things are difficult, but there are ways that you can invest £100 a month. I think it's possible for pretty much anyone. You could make a few sacrifices to make this happen, but for your long-term future and stability, I think this is worth it, which is something that I have been doing personally. Over decades, contributions, growth, compounding become more and more and more powerful. Obviously in the UK as well, if you do this within one of your ISA accounts, you can invest £20,000 in an ISA every year, and everything that you take out of that will be tax-free in the future. So if you do this over 20 years inside an ISA, you make yourself 300, 500, maybe £1 million, depending on how much you put in every single month. All of that money will be tax-free. No capital gains tax, no tax on your dividends. All of it will be tax-free. So it's something very, very interesting that you can consider. As you can see here, what you can control, how much you save, how much you invest, your fees, how diversified you are, and how long you stayed invested. Personally, I think buying the global ETF is pretty much as diversified as you can be, and I would say the lowest risk that you can be, because obviously there will be ebbs and flows with the economies of all countries, and the reality is you'll be exposed to all of that equally, and it will mitigate some of the risk and also introduce potentially some of the gains of some of these countries as well. As you can see, tomorrow's market, the next crash, interest rates, politics, which stocks will win 20x next. These are things you can't control and it's very hard to predict. The real challenge is buying an ETF is easy, but staying invested and consistent is extremely difficult. As humans, we know it's very, very hard to be consistently invested in the stock market for a long term. We know it's difficult. It is very tough. Staying invested for long periods of time is very tough. But what happens to your psychology when there are the inevitable 20 or 30% dips, 40%? Can you keep going? This is where your psychology will be key. Imagine the COVID crash. Say you get into buying the ETF in 2018. You invest for a year, you get yourself £1,000 or £2,000 or £3,000 invested, you're feeling good, you're feeling happy, the market's going up, and then all of a sudden COVID crash happens and your £3,000 drops to a 30% crash. It drops down 40% down below down to £1,800, and all of a sudden the money you've invested has been wiped out in the space of a day or two. Can you continue to go for the long term and invest? Because if you did, as we know, since the COVID crash, markets are at all-time highs, everything's continuing upwards. So my final message for you, you don't need to be the world's greatest investor. You don't need to be doing as well as some people will. There's always people that will be doing better than you, but there's always people that will be doing much worse as well. You need a strategy that you can stick to. Can you just buy the global world ETF consistently for years and years? That's what I've been doing for 10 years now, and it's been done very well for me, but it hasn't been easy. The COVID crash, like I just said, for me personally, was a big point where I thought, I've lost all my money. But the reality was, I kept buying through the dip, and we recovered within a week or two, and then we were back towards all-time highs before we knew it. And now in 2026, after 10 years of consistently investing since I was at uni, things are getting better. Things are getting better and better at a rapid pace. But it doesn't mean that it's easy. But it does mean that it's possible, and I think this is possible for anybody who can just go to a broker. There are loads. IC Markets in the UK is excellent. We've also got Trading 212 who are excellent. They're insured up to £100,000 in investments if they go bankrupt, which is excellent as well. FDIC insured, regulated by the financial brokers. And you can go there and you can invest £100, £200, £500 a month in your ISA. All of it will be tax-free in the future. Do it consistently for a long period of time. And I'm not saying I guarantee that you'll make money, but it's very likely, in my opinion, that the markets will go up in the long term. It just depends if you can stick it out. As you can see here, for many people, the strategy that you could stick to could easily just be a very diversified ETF, like, for example, the one I'm talking about here, VWRP, that I've been investing in for the past 10 years, reinvesting dividends back into it, compounding, regularly investing for the long term, low costs, and just the long-term thinking of, I'm just going to buy every month on a direct debit. I'm not going to look at my portfolio too much. Maybe I check it once every few months just to see where it's at. But it's not something that I'm going to be looking at every day and panicking over. And in my opinion, this kind of investing is, for 99% of people, the way that they can build long-term wealth. And it's very likely that that will be the case for a long time to come. I personally feel, as I've said, this is not financial advice, but I personally feel that over the next 50 or 100 years of investing, the reality is that the global stock market will continue to go up, money will continue to be generated, wealth will continue to be generated, invested in companies, things will ebb and flow, there will be crashes, there will be massive bull markets, but I think being involved for the long term is a very good chance of creating generational wealth, and it doesn't have to be so risky and complicated as, betting it all on one stock. So, as you can see here, the long-term thinking and doing absolutely nothing while everyone else is panicking, for me, is something that's very important and something that will generate and is generating wealth for millions of people that are doing this. So, my final line to leave you with is, the hardest part of investing isn't finding the perfect investment, it's having the discipline to leave a good investment alone.